Hello students, welcome to iExamB. So as you know, for SEBI grade exams, expected exam dates are likely to be in the month of January and February for the phases. And information regarding the same was shared with you all by Prachi Ma'am and Sushil sir few days back. As we are also starting 100-day study plan where live sessions will be conducted for the respective subjects daily. And you can check on the information, and for that matter, we have started this series for SEBI Grade A exam wherein we will be discussing few topics which are significant for the respective exam. So today's topic for discussion is IPO market. So hello once again, I am Shikha Malhotra, finance faculty at iExamB. I have more than 9.5 years of working experience with State Bank of India, and I am CFA level 2 FRM certified. So let's start with today's topic, that is initial public offer, that is IPO. So a public issue may be defined as an offer for subscription by a company of its securities to the general public. So as we know that capital market consists of two very important segments, that is one is primary market and the other is secondary market. So these two segments are interdependent and inseparable. This primary market is called the new issuer market and it is termed as the stock market. So primary market is used by the issuers for raising fresh capital from investors by making IPOs, rights issue or offer for sale of equity or debt. On the other hand, this active secondary market promotes the growth of the primary market and the capital formation, because investors who have been issued these securities in the primary market are assured that there will be active trading of those securities in the secondary market, where they can even have an option to liquidate their investments. So the corporates raise capital in the primary market by IPOs, FPOs, that is further public offer, rights issue or private placement. An initial public offering is the selling of securities to the public in the primary market. So it is the source of funds for these corporates for making their investments, further investments or for their further expansion, and also to meet their existing debt obligations. So important, this is a very important step in the growth of the business. Right. So this is IPO. So initial public offering occurs when a private company makes its shares available to the general public for the first time. So IPO is a means of raising capital for companies by allowing them to trade their shares on the stock exchange. This is what we discussed. So IPO market in India, there is so much of buzz around IPOs markets in India, at least since last year, that is 21. And India was poised to emerge as one of the top IPO destination in terms of proceeds in the year 21. This was called the blockbuster year of public offers despite so many hiccups. Right. So 21 was considered the year of IPOs and the markets were majorly witnessing a boom in the tech startup market that cater to the internet market. So RBI had once said that India's tech boom had been long awaited with strong global and domestic appetite, and it is widely believed to be world-class business in the pipeline. So this initiative of the IPOs coming in has been backed by the growth of startup ecosystem in our country, because from a mere 471 startups in the year 2016, they have been raised to 20,160 in the year 21. This has created a lot of opportunities in terms of employment and in terms of growth of various companies. And the country is also home to almost 105 unicorns with a total valuation of around $335 billion US billion dollar, and 63 of them, almost 63 of them were born since last year. In fact, one of every 10 unicorn in the world is from India. So what is unicorn? Unicorn, as we say, these many unicorns in India. Unicorns are with $1 billion of valuation. right? So in India also, unicorns that offer to expand their growth through public offering include Zomato, Nykaa, Policy Bazaar, Paytm. And also from Indian startups, Flipkart, Byju's, and Swiggy, they are now not even unicorns, they are decacorns, because their valuation is more than 10 billion US dollar and above. So globally, there are almost 47 decacorns. So this startup ecosystem has registered almost 15 times increase in funding and 9 times increase in number of investors. And then continued by the same, 22 also saw a very great, a behemoth IPO, that was LIC. So LIC, one of the government's largest stock market offerings, and dilution of 3.5% dilution of stake, with an offering of almost 21,000 crores. But this was offered at the time when the rise in inflation in a global setup, and also Russia-Ukraine war was hitting the headlines. So that's why the day it was listed, on the first day, it was listed at 9% discount from its offer price of 949 rupees. So what happened? What is this? What exactly happened? The situation of the market was the reason, or anything to come by? Actually, finance minister had announced in the year February 2020 budget that there would be LIC would be listed on a stock exchange. So expectation was selling the part stake in insurance agent would raise almost to meet a divestment target of at that time 2.1 lakh crores. For the government. So since then, divestment targets have been slashed year after year. So initial expectation even was to sell the partial stake and raise between almost 50,000 to 70,000 crores. So, but the ultimate dilution that was happened was 3.5% with the offering of 21,000 crores. So year 21 is considered was the bumper year for Indian primary market. 63 companies almost collectively raised more than 1.2 lakh crores of IPOs. So companies like Paytm, Zomato, Nykaa did exactly that. They actually leveraged on the situation of the market, and they read a raging bull market for what it was, and decided to strike while the iron is hot. So as we can see that for the last few years, there has been a considerable buzz around the IPO market. So we will just understand in brief what exactly the IPO market is and how does it operate. So process of initial public offer. What is the process? The first process, the first step in this regard is hire an investment bank. So before that, so why do companies go for IPOs at the first place, right? They go for because they want to do an expansion of their existing business. They want to venture into the new business. They want to acquire a new entity for that matter, and they want to pay their existing debt obligations, right? Also, they can also pave the way to make an exit to the previous investors. So there can be number of reasons, and for that matter, there are several ways these investments are raised, because for every company which is a startup, then there are several options of raising the finance. Then first is the promoters finance from their friends and from their relatives, or promoters finance is there. Then comes the angel investing, and then comes the venture capital or the private equity, and then is IPO, right? So coming back to IPO, we know that in the IPO, the first step is hire an investment bank or an underwriter or a lead manager. So these lead manager or underwriters, they are independent financial institutions that are appointed by companies, and they are responsible for coordinating all the activities surrounding the issue, right? So the criteria for selection, it matters, like various factors are involved. The reputation of this investment bank, because many banks like ICICI, HDFC, they have their investment banking arm that offers services for all these issue markets, for the mergers and acquisition, etc. So the reputation for investment bank in doing this underwriting process in the past, and the quality of research that they do, because whether this IPO is successful in terms of getting the investors also at the right price, that also matters a lot. The quality of their research, the expertise in their field, and obviously the past relationship with the respective investment banker. So this is the criteria that actually is started, that is actually identified by the companies who are offering their shares to the public through IPOs. So next step is due diligence and filing of required documents. And once it is decided that whatever investment banker or underwriters they have approached, they are meeting the requirements in forms of their expectation, then this agreement, underwriting agreement, is also signed with them. So next process starts with the due diligence and filing of required documents, and that is underwriting. After underwriting agreement is signed, then underwriting is to be done by these lead managers or underwriter. So for that there can be different types of underwriting, that is firm commitment. One is firm commitment, and another is best effort commitment, and another is syndicate underwriting. So in firm commitment, they take the full responsibility of buying the issue also if it is not subscribed by the public. Best effort is like they will be making a best effort, but they will not make a commitment of buying it. Syndicate is when the proportions are, when the whichever offer is being made, that is shared by the various investment bankers in proportion, that together they do, that is a syndicate underwriting. Then the next is one very important document filing, that is draft red herring prospectus. So it includes a very important information about the company, their business, the industry they are in, the current shareholder, their financials, their competitive advantage, and their promoters details, their capital structure, their future business plans, and why they are actually raising these funds, and for what need these funds will be deployed for. So this much information is very important for the investors to decide whether to invest in these respective companies or not. So these DRHPs are available on the SEBI website also, and it can be accessed by the investors so as to make a decision, and after analyzing their financials and other respective information, so that whether they want to make an investment in these companies or not. So after all these mandatory requirements are, like, it is actually this DRHP is prepared by underwriters in coordination with the company, and it is a significant document. As I told, it's a source of information about the company. And also document is also used by underwriters to market the IPOs as well. So this prospectus is submitted to SEBI, and it reviews it, and it also checks it whether the adequate disclosures are being made, or if there are any errors, it sends back until it complies with all the guidelines. So in the meantime, application to the respective stock exchanges are also made, for that matter, wherein the company wants all these shares to be listed. It can be any stock exchanges, right? So another is the pricing of the issue. So pricing of the issue, the parameters are decided in terms of the valuation of the company. This valuation is also given by these investment bankers, and the issue size, the issue price, and also the lot size, right? So these parameters are decided, and also the pricing for the issue, the method for the same, that is the fixed price issue. In this case, the price of company stock is set, announced beforehand. And another is the book building issue. So book building issue, in case a company sets a price band wherein the floor price and the cap price is set. So in between, it is offered to the investors to make a bid for that price. right? So this also book building issue also is a long process. It is actually there are SEBI guidelines also for book building process, and we can also discuss for the same in detail in the next set of videos. Another is distribution and marketing of issue. So after all these parameters are decided, then there is a need for marketing the issue. So, and it is undertaken by these underwriters along with the suggestions from the company. They would travel, create a buzz around the IPOs, and they also meet business analysts and fund managers, and also they will conduct various road shows, Q&A sessions, virtual meets, in order to create a buzz around this issue, so as to attract the attention of investors. So this is distribution and marketing of issue, and the whole criteria of selection for these investment banker also depend on how far they can distribute, and expertise in the form of their distribution and marketing of issue as well, right? So after that starts the application process. So after this final prospectus, that is called red herring prospectus, after this pricing is also decided, final prospectus and application forms are made available to the public online and offline. So investors can apply for IPOs during this period. And then after that process, the share allotment process is also undertaken. It is decided along with the company and how the subscription has taken place. So that is also a one process that needs a consideration. And after that, everything is decided about the share allotment, and then the stock gets listed on a stock exchange. So there is also a timeline that is decided, that is within that period the listing on the stock exchange would happen. So this was a brief process of how how IPO unfolds, the process how it unfolds. So as we have seen lately in the past, that many IPOs on the day of their listing, as I gave you an example of LIC also, that they actually tanked in their prices in terms of from the issue prices. So with this regard, as SEBI had actually come up with certain guidelines also, not only for that matter but also for certain other matters, that SEBI had come up with certain very significant guidelines, so as to keep this whole IPO process very transparent and efficient, and a smooth process for the investors, and a fair deal for all these investors. So one such is that if a company has not identified any acquisition or investment target, the amount for this and amount for the general corporate purpose cannot exceed 35% of total amount being raised. And if the acquisition target, because if the company is raising fund for acquiring something, and if acquisition target is not identified, the amount cannot exceed 25% of the total amount raised. So what is the reason for the same? Because many companies were raising money, not because they had certain requirement, but market was hot and there was a buzz around it, and the sentiment for IPO was strong at that time. So the companies would give the vague and reasons that how would they be using the funds raised through IPO. So that's why this new guideline has come into force, and with closer scrutiny, companies will be more judicious about how much money they want to raise, right? So that was the impact. So other is anchor investors. Anchor investors can sell half their shares after the 30-day lock-in, but can sell the remaining shares only after 90 days from the date of allotment. The previous rule was that these anchor investors had a lock-in period of 30 days from the date of allotment. But now question comes, who are these anchor investors? Who are these anchor investors? They are qualified institutional buyers who purchase shares one day before the IPO opens, actually they play a very instrumental role in arriving at a fair price, and also provide confidence to the investors, because these such bigger qualified institutional investors, if they are making investment to a great extent in this particular offering, then investors will also get the confidence in this regard. Right, so SEBI introduced this concept of anchor investor in 2009 to enhance the issuing company's ability to sell the issue. And Adani Power was Adani Power IPO in July was the first issue in the country to attract investor under the anchor investor scheme. So coming back to this once again, so that's why this has been changed. Reason was that many companies were allotting shares to these bigger anchor investors with big names to ensure that their IPOs get the good limelight and good response. But many anchor investors would just play along and they would make an exit immediately after 30 days. So definitely it was very hurting for other non-institutional investors who were still holding them. So for that matter, this guideline had come into the picture. Another very significant rule was upper band price band has to be at least 105% of lower price band. For example, if the lower band is 100, then the upper band has to be 205 at least. So this also was kind of very significant change, because earlier rule was companies going public could set a price band as and when they desire, as and what they desire. So reason for introducing this was that price band in book built issues, they exist for a reason, right? Because the basic reason is to ensure that there is an appropriate and adequate price discovery, right? But this was actually followed just like that. There was no meaning to it, because there were difference used to be so small between the lower and upper band that it was just, not serving the purpose of price discovery, and investors were like, just making a bid for the higher upper band so as to ensure that they will get the allotment. So if this promoter and merchant bankers or these underwriters, actually they were already deciding with the price, and then they were just setting it as meaninglessly to just comply with the rule. So most investors were forced to bid at the upper end, so that the fear of missing out, FOMO, so that they would get the deal for the allotment. So in this case, the impact that is actually expected from this kind of guideline is that companies will be forced to price their issues more realistically and more rationally, so as to facilitate price discovery in a better and efficient way. Right. So another is existing shareholders owning more than 20% of pre-issue cannot offer more than 50% of share in an IPO. Those holding less than 20% of pre-issue cannot sell more than 10% of their shares. So many companies were coming out with IPOs. That's what the reason I had stated earlier, not because they needed capital, but just to facilitate making an exit, offering an exit to the existing shareholders, basically the private equity funds. But because there was so much of hot deals in the IPO market, there was a buzz around, so that's why the valuations also were higher, right? So this actually worked for the early investors, but at the expense of the investors who were coming through IPO. So that's why this new rule was set in, wherein previously there was no such rule like that. So early investors, actually with this new guideline, they were forced to have some kind of skin in the game. They should be having some skin in the game also. You must have heard this word a lot if you have watched Shark Tank and all. So that's why each investors will be forced to have that some skin in the game. This could incredibly result in better pricing of the IPO, right? Because if some disaster happens in the secondary market, then it would actually hamper and for the small time investors to a great deal. So SEBI always does something in order to protect the interests of investors. Similarly, another very significant guideline that came was rating agencies to monitor use of proceeds till 100% of it is spent, right? So there was a previous rule that this was not monitored earlier by rating agencies, but now this has to be monitored by rating agencies till 100% of it is spent. And many companies are known to actually use the funds in some other way for what it was stated. So that's why this guideline was set in. So impact is that how the rule will be imposed, how the rule comes into force and how it sets in and it impacts the companies in a way, how it adds layers to the compliance rules, that has to be seen. So now question for a day. So this is after this IPO and the whole process and some new guidelines that we have discussed. So there is one question I will just put in, and then you can reply for the same in the comment section. So SEBI has divided the non-institutional category into two ways based on the application size for book build issue. So what proportion of non-institutional buyer has been reserved for application size of rupees 2 lakh to 10 lakh? So the options are 1/4, 1/3, 1 half of that, 2/3 or 3/4. Right, so these are the options. This is also a new rule along with the IPO guidelines that came into force, and as there is a separate proportion that is reserved for qualified institutional buyers, non-institutional investors, retail investors, and so for this question you can answer and comment in the comment section. So for today, that is it. We will be coming up with a new topic for discussion. Also, if you want any other significant topic to be discussed, you can also reply in the comment section for that. So thank you for today. And on this Teachers Day, that is 5th of September, we are starting with a new batch, as I told you earlier, that is 100 days study plan, wherein the 100 days live class schedule is there for SEBI Grade A General Stream. And you can download the PDF for the same, and special sessions are also likely to be conducted before the 100 days class plan for non-commerce, non-finance students. So do check in and do subscribe to the same, and thank you for today. So please don't forget to subscribe to the iExamB channel and don't forget to press the bell icon. Thank you.